Good morning, and welcome to Bank7 Corp's third quarter earnings call. Before we get started, I'd like to highlight the legal information and disclaimer on page 26 of the investor presentation. For those who do not have access to the presentation, management is going to discuss certain topics that contain forward-looking information, which is based on management's beliefs as well as assumptions made by and information currently available to management. Although management believes that the expectations reflected in such forward-looking statements are reasonable, they can give no assurance that such expectations will prove to be correct. Such statements are subject to certain risks, uncertainties, and assumptions including, among other things, the direct and indirect effect of economic conditions on interest rates, credit quality, loan demand, liquidity, and monetary and supervisory policies of banking regulators. Should one or more of these risks materialize, or should underlying assumptions prove incorrect, actual results may vary materially from those expected. Also, please note that this conference call contains references to non-GAAP financial measures. You can find reconciliations of these non-GAAP financial measures to GAAP financial measures in an 8-K that was filed this morning by the company. Representing the company on today's call, we have Tom Travis, President and CEO, J.T. Phillips, Chief Operating Officer, Jason Estes, Chief Credit Officer, and Kelly Harris, Chief Financial Officer. With that, I'll turn the call over to Tom Travis.
Thank you. We also have Paul Tillman with us, who is Kelly's right-hand person, and shout out to Kelly and Paul for their great work, but also getting the information out very timely. So I'm not surprised. We have a great group. So good morning. Welcome to everyone. Before we launch into our results, we're certainly aware of the devastation inflicted by the recent storms on our fellow citizens, and our thoughts and prayers certainly go out to them. Very trying times over in the eastern seaboard for sure. As we move into our strong financial results, we're excited. We're cautiously optimistic, even in the face of this upcoming and very divisive national election. It'll be nice if we can tone down the rhetoric for sure. Clearly, we're in for some choppy waters over the next few months, and yet we're continually stressing how comforted we are to be in this part of the United States. It's a real geographic financial advantage for sure. With that in mind, those issues are still always on our mind, and this is certainly a time for caution. And that's why we take such comfort in our fundamental strengths, especially the high levels of capital. And it isn't just the higher levels of capital that gives us that comfort. We have a very strong liquidity position, and we further enhanced that last quarter by adding a second liquidity backstop, and that being the new Fed facility, which is now in place should we ever need it in times of stress. So we now have two meaningful sources of additional liquidity, the FHLB, which we've had for a long time, and the new Fed facility. Our disciplined approach to maintaining that properly balanced, matched balance sheet has really been proven through the rate cycles. And those of you that have followed us over a long period of time, and I know that we include in the deck the spread management that compares our spread through up and down rate cycles in the various treasury markets, it's a great strength of the company. And really, it's the foundation, along with our credit quality, that produces these results. And as you can see, record earnings and a record EPS, not only for the recent quarter, but our year-to-date results. And so we're very proud of those accomplishments. And those were achieved through normal operations. And in the case of our EPS, they weren't driven by share buybacks. So our strong earnings and capital levels were the driving factors that motivated us recently to make a large increase to our cash dividend. But even with that large increase, our dividend payout ratio is still in the 20% range. And when you compare that to banks that do pay dividends, the average is a little bit more than 35%. So Bank7 has plenty of room for further increases if we want to do that, while at the same time being comforted by our top-tier earnings that rapidly accumulates capital. And as majority shareholders, we're really pleased with the total shareholder returns produced by our company. And as you can see in the published materials, we rapidly compound shareholder value much faster than almost any other institution. Our results are certainly attributed to our outstanding team members who work with our loyal customers. We're all very aligned, and we're really looking forward to our future. And I can't thank the team members enough. So with that said, we're certainly ready for any questions and ready for Q&A this morning. Thank you.
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star, then 2. At this time, we will pause momentarily to assemble our roster. And our first question today comes from Woody Lay with KBW. Please go ahead.
Hey, good morning, guys.
Morning, Woody.
Good morning. Wanted to start on the loan growth side. I mean, the growth was great to see in the third quarter. I know there was some commentary last quarter that there was some funding delayed. But I was just curious how the pipeline is looking entering the fourth quarter.
Yeah, so thanks for the question. Last quarter, we were very confident, that we had a lot of fundings coming. This quarter, I would say, I would expect us to finish more in line with where we are now. I wouldn't expect another nice growth quarter. But I think, here we are kind of ending up in that range we've talked about for the full year of, kind of a moderate to high single-digit loan growth for the year. And I think we're going to be right in line with that. I think in general, there are certain segments we restrict, to just continue to mitigate the risk in our portfolio. And so we continue to see opportunities there, and we're passing on more deals, specifically in the hospitality space, the energy space. Those two components, we continue to really sift through opportunities to make sure we're optimizing the portfolio return with those dollars that we restrict, by our own intent. So all in all, should fall right in line with what we thought at the beginning of the year.
Yeah, and as you talk with clients, have you noticed a difference in activity now that we have a couple of rate cuts behind us, or is it still about the same?
About the same.
And Woody, this is Tom. I would add to Jason's comments that, again, this goes back, I believe, to two factors. One is the geographic advantage of the robust nature of this part of the country. And two, it confounds me on a regular basis how the financial mentality has been about, quote, higher interest rates in the United States. And I think that's just been somewhat of a false narrative. And what I specifically mean is, I don't know the exact number. I know that Jason and Kelly and I looked at this 4 or 5 months ago, and I think we went back for the last 60 years, and I think there's only 9 times where the 10-year Treasury was higher than where it's been. And so I think this narrative evolved when the Fed started raising rates that, oh my gosh, we're in these high interest rates, and then that bled into borrowers aren't going to be able to make payments or, economic activity. And when you really look at long-term averages, it really hasn't been an interest rate story. It's been a cost story that may have had a dampening effect on companies borrowing money and building projects and investing in capital goods. And so I'm not trying to be long-winded here, but I think it's important for all of us to remember that we're operating in a very normal interest rate environment. And when you marry that with where we are in the part of the country and the inward migration, it's just a very nice, steady, ambient level of economic activity. And
And that's why the growth continues.
That's right.
Throughout the last, call it 15 months, 18 months.
That's right. And I said another way, I mean, we bounced into modern history of the United States, historical interest rate lows. And so when you bounce off of that, people think, oh my gosh, the rates are high, but that's just not the case. Go look at the research, go look at the historical numbers on the treasury markets, and so anyway, enough of that. But we feel really good about, as Jason said, we could have put even more loans on the books, but we're trying to be very careful.
Yeah, no, that's really helpful color. I guess shifting over to more the deposit side, I really appreciate the color you provided on the loan betas and the deposit betas and how those shifted with the recent rate cuts. And I was a little surprised to see the deposit beta sort of go in lockstep with the loan beta. Did you see any deposit runoff when you made those rate adjustments? And with future cuts, do you think you can continue to cut deposit rates as aggressively?
I think this is Tom again, Woody. We're not surprised. Your comment about you were, I forget your words, but you noted how we had gone lockstep, and I think it goes back to my opening comments relative to a properly matched balance sheet. And we work so hard, and we don't take our eye off the ball relative to loan floors and floaters and, keeping our fixed rates, I think it's 24% of the loan portfolio or something like that. And even those are rapidly amortizing. And so the end result is a very properly, methodically applied concept here. I would tell you that we have modeled, Kelly, what did we do? We did 4 columns. We did 25, 50, 75, and 100 basis points. And I guess I would use the term non-issue for the first 100 basis points, Kelly?
Correct. And then once you get through the first 100 to 150, that's when you start to see the floors really start to kick in.
Right. And so historically, it becomes more difficult as you get into that 100 basis point territory, because you do have customers that will want to come in and say, hey, I think my floors are, maybe too high, and I want to renegotiate. But again, we've lived through these cycles, and we've been very successful. And so, yes, it might get a little more difficult, but at the end of the day, Woody, we are very comfortable operating our NIM and our historical ranges, and that's really the final message.
Yeah, well, that's all for me. Congrats on the great quarter.
And Woody, I have a question. This is Tom. I noticed your target was $40. It seems to me like you're sandbagging because we're almost already there.
Well, it was a great quarter, so we'll see where it goes from there.
We appreciate your coverage, Woody. Thank you.
Yep, of course. Thanks, guys.
Again, if you have a question, please press star, then 1. And our next question comes from Nathan Race with Piper Sandler. Please go ahead.
Hey, guys. Good morning. Thanks for taking the questions.
Hey, Nate.
Good morning.
Just going back to the margin commentary previously, I appreciate you still expect the margin to remain kind of within that historical range, but, just given that you guys posted, 20% plus NII growth as short-term rates are going up the last couple of years, just curious how you're thinking about NII growth prospects in the next year, just given that, short-term rates are expected to decline from here.
Yeah, so, Nate, I think that one of the things that's not really been spoken about on this call yet is the fact that, banks in general in 2023, after what happened in March, really tightened up on lending money. And so our net interest income and our NIM, that's been helped because we've been able to be more stubborn on giving in negotiations on loan rates, okay? And that's allowed us to give in a little more on deposit rates. And so, there's different I would say, variables involved as we're negotiating loans and deposits and trying to attract new clients and take care of our existing clients. But in general, I hear you. Yes, there's been pressure, but we've been able to navigate that because they're really, in our market, you still have good, healthy economic growth, and you have, I would say, fewer banks really pursuing loans. There's always competition, but I think the level of competition for loans, it shifted a little bit, last year, really in the second half of the year. And yeah, I'm sure that's going to normalize, and it wouldn't surprise me, as we continue to try to grow both loans and deposits going into next year. If some of that restriction or governance that we've seen on some of these competing banks, if they start to return to more normal competing levels. And so, I think we've talked about this now for several quarters in a row that we could see our NIM, gradually sliding down, but, we're fighting every day to maximize it.
Got it. That's very helpful. And while we have you, Jason, just would be curious to hear an update on the credit quality front. It seemed like, non-performers are relatively stable in the quarter. So just curious to hear what you're seeing in terms of criticized classified trends these days.
Yeah. So, we were up $1 million, roughly in the quarter, but there's a lot that's actually gone on there that doesn't really show up in that individual number. We had a couple of really nice results. The largest NPA we had left, we actually got $1.6 million in principal reduction during the quarter, and we had the final tail of the energy credit paid off. That was $1.1 million, and so we collected just under $3 million on last quarter's numbers from the NPA and principal, which is a good result. We did have 2 new relationships show up on this list that are on non-accrual. I think those 2, we don't expect meaningful loss there. One approximately $3 million, the other one $750,000 in total balance. But I do think those will stay on here through year end. But my goal is always work this number to 0, and so we've had good results throughout this entire year. Credit-wise, the portfolio is performing well overall, but, still always, the book's big enough now where, there's enough clients, there's enough exposure to various areas and industries, and so we're always eyeing something, but we're working through those successfully.
Okay, great. And then just in terms of thinking about the future provisioning levels, if growth kind of reverts to the mid-single-digit range going forward, any thoughts on just the provision and kind of where you'd like the reserve to kind of trend over time going forward relative to, I think, 1.25 coming out of 3Q?
Yeah, this quarter, depending on, what happens with the economy in the fourth quarter, I still expect us to operate in these same ranges, as long as the portfolio holds up and the economic activity stays, similar. Knock on wood, it's been really good in Texas and Oklahoma, and so we're hopeful that it continues kind of in the same ranges.
Yeah, and I think to add to Jason's comments, Nate, this is Tom. As we've commented before, it's the Rubik's Cube, so to speak, and what I specifically mean is we carry a significant amount of cushion over and above the PCA levels of capital. And Kelly, I don't remember, do we put that slide in the deck? I know we have the stress test. I don't think we do, but I have it in my lap. But if you look at the cushion, the dollar cushion of where we are relative to excess capital, if you want to call it that way, you really are in a splitting hairs environment, whether it's 125, 120, or 130. And so we really look at those factors in tandem. And as an example, it's not in the deck, but I've got it here. Just on the CET1 ratio, we have $98 million of excess capital just over and above the prompt corrective action levels. And it's kind of consistent with you go through risk-based capital at 60 some odd million. So we don't really feel like that we're going to always, I mean, we're mindful of CECL. We have a very precise application of our methodology, but we're not conflicted at all about minor variations. And a lot of that has to do with how great of a job Jason and his staff do on asset quality. So that's a long answer, but that's kind of how we feel about it.
Got it. That's helpful. And one last one for me. Tom, as you described, you guys are creating capital at pretty strong clips, to say the least. So just curious how you're thinking about the M&A environment today and just kind of the acquisition prospects going forward.
You know, Nate, you know us well, and, you know, there are, I'm pretty certain, a few people on this call that I've interfaced with relative to the M&A space this year and continue to do so. We were pretty far down the road on a particular potential transaction earlier this year that ended up not doing. I would tell you that the market is very robust, and we are constantly, over the last 4 or 5 months, being approached, not as a potential person to sell, but as a bank that's known for, you know, public currency and a high-performing bank. And so what's now starting to increasingly occur are quite a few opportunities, and some of which are, unfortunately, what I call the zombie banks, who are really stuck with AOCI issues, or not just in their securities portfolio, but also in the loan rate, interest rate mark world. And I don't want to be as bold or forward to say that some of these banks may have been using hope as a strategy relative to interest rates falling and therefore unwinding some of that AOCI and interest rate marks. But I think the reality has hit in many places, and I mean, if you just look at it, the 10-year is still around 4% today, right? And so I don't remember where the 10-year dipped, but I think there are, based on the volume of opportunities that are being presented to our institution because of our performance and our currency, but also the fact that some of these banks have, I think, come to realize that it's a slower boat to China relative to unwinding some of these marks, that I would expect that more opportunities that were more discussion type, exploratory conversations will convert into actual transactions. And we certainly see that. You know, we're constantly engaged. We have some specific targets and discussions, and so we've always been consistent that we want to build capital to be opportunistic, and I would expect transactions to occur, given all those dynamics, sooner rather than later in our space.
Got it. That's great color. I appreciate the commentary. Thanks, guys. Congrats on a great quarter.
And our next question comes from Matt Olney with Stephens. Please go ahead.
Hey, good morning. Tom, on those last comments on the M&A front, just remind us of the characteristics of an M&A partner that you're looking for as it relates to size and geography, and just the type of bank you're looking to partner with.
You know, Matt, we've been consistent in our history, and I like to call it, you've heard this many times, the right side of the balance sheet. And so we are, you know, we have opportunities now, and we're evaluating a handful that are really nice core banking groups with core funding and really good cultures. And so I guess I would flip the coin over and say that we're not, what we're not interested in are, specific verticals and fintechs and, earnings. We're interested in people that are culturally aligned, that would bring a really nice balance sheet to the bank and blend really well with the Bank7 team. And as far as size goes, we're excited about, we compound equity so quickly and we have excess equity. We would love to do an MOE. I think those are fun to do, and they're also very rewarding to the shareholder base and our executive team. We're big bank people, and we're, without sounding arrogant, we're properly trained. And hopefully, as you followed us over the last 6 years and all those quarters, what is that, 24 quarters now since we've been public, and we've been rock steady with our reporting and no misstatements. And I think that, again, I give so much credit to this team and how precise and professional and top-tier performing they are. And so when you really think about that, married with the excess capital and the compounding of equity, an MOE or a $2 billion or $1 billion or whatever it is institution is right in our wheelhouse. And so, and I think that those are the preferred things. Does that mean we wouldn't do a $500 million acquisition? No, we would. So if those characteristics are in place, that's how we would see the future.
Okay, that's great, Tom. Appreciate that. And I guess on the sticking with the M&A theme, there's lots of financial metrics to consider as you review these. In your view and the board's view, what are the more important financial metrics to review as you kind of go through these various M&A options?
I think it's a very difficult question to answer because, look, some people are more focused on earn back, some people are more focused on PE ratios and tangible book value and deposit premiums. And for us, really, we are guided by long-term fundamental principles. And so all of those metrics have to coalesce, they have to merge and blend. And so with that being said, you're not going to see Bank7 get outside of any normal or right down the middle of the fairway parameters. There's no reason for us to do that. And so, if you look at us and again, not trying to, prop ourselves up, but these are just facts, but we are a top tier organization and we're top 1%. And you look at that in any metric, whether it's efficiency ratio, ROE, ROA, credit quality, we are just liquidity. And so when you really look at that, we're trading at, where are we today? About 1.8 or 2 times book. And then, our PE is 9.5 or 10. And so when you start thinking about, some banks and they seem to think that, or maybe the investment bankers, with all due respect to you guys, go in and say, well, we think you guys are worth, metrics that are anywhere near what I just described, but yet their performance is not there. It's a pretty tough, thing for us to accept that. And so what we try to do when we approach as we do, and so we'll pay a very fair price, and it'll make a lot of sense, and then the rising tide, so to speak, will raise both boats going forward. And so that's not a specific, metric by metric, answer for you, but it's how we view things, and we view things over the course of a 3 and a 5 year, strategic period.
Okay, great. Appreciate the commentary, Tom. And I guess just stepping away from M&A, going back to the core margin discussion. You talked about kind of maintaining that historical range, regardless of what the Fed does in the near term. Any general commentary about the core margin as it relates to the Fed? So if we were to see a very active Fed cutting each meeting 25 or 50 bips versus a more methodical, slower moving Fed cutting maybe every other meeting, just any commentary about kind of directionally what that would mean for the core margin? Thanks.
I just think historically, you can go back to the COVID years and go back to the slide that we have, and nothing concerns us, our ability to manage that. I don't know what page that slide's on. It's on page 9, but we've gone back to 2016 and shown our spread compared to the 5-year, the 10-year, and cost of funds, and so there's nothing that would indicate to us. And again, we've modeled it, and we're not concerned at all. So I think the non-fee income NIM components. What's the low point? 438. 438
for a full year.
Right.
Yeah.
And I think Jason has said, in the past, and I think he's right, that at some point, as the bank gets larger and larger, you say, well, maybe you touch those lows, and maybe it goes to 4.25 or 4.15 if you get it to be a really large bank in a certain economic environment. But if that were to ever happen, then fine. We're still going to be a top-tier bank.
Okay. Thanks, guys.
Thank you.
Our next question comes from Nathan Race with Piper Sandler with a follow-up. Please go ahead.
Yeah, thanks for taking the follow-up. Maybe a question for Kelly, just in terms of thinking about the impact within fees and expenses from the oil and gas assets going forward.
Yeah, Nate. For Q4, we do feel like that we saw peak revenue and expenses from an oil and gas perspective in Q3. And then that said, non-interest income combined bank-wide $3 million, and 2.3 of that's going to come from the oil and gas, and $700,000 coming from core fee. And then from a non-interest expense perspective for Q4, we're modeling $9.5 million, with $1 million coming from the oil and gas, and $8.5 coming from core. So core non-interest expense up a little bit quarter over quarter. Historically, our fourth quarters have been a little bit higher in that perspective.
Got it. That's helpful. And then one last one. I know there's some noise in.
Hello? Nate, are you still there?
Did you not hear my question?
No, we didn't.
The phone cut out.
I apologize. Just the last question around non-interest-bearing deposit levels. I know there's some noise the last couple of quarters tied to some legal matters, so just curious how you're thinking about that trajectory going forward.
Pretty flat, just our normal growth. We did have that large $100 million deposit that flowed out of here earlier this year. And then I'd say pretty flat, nothing major either way.
Okay, so it seems like some of the mix shift changes have largely slowed across the client base lately, if not entirely. Okay, great.
Yes.
I appreciate you guys taking the follow-ups. Thanks again.
Thank you.
This concludes our question and answer session. I would like to turn the conference back over to Tom Travis for any closing remarks.
Well, thank you all for your interest. We appreciate the coverage, and we look forward to the future. Thank you. Bye-bye.
The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.